So, let's discuss the cost of commercial bank financing. So, when we say the cost of commercial bank financing is measured in terms of the effective interest rate. This is the actual rate charged by banks or other lending institution on the borrower. So, the following variable used in the effective interest rate are as follows. First is the interest amount. Second is the interest rate. So when we say interest amount is when you put your money in savings account. Interest is the return you receive your savings from the bank. When we say interest rates, indicate this cost or return as a percentage of the amount you are borrowing or lending. Since you are lending your savings to the bank. Third is the days loan outstanding. So when we say this, it means the amount that is left to be repaid on any loan. So four is the method of interest charge. So when we say it is a method of how you pay your interest. And there are the fifth is the type of loan. So when we say the type of loan, we have a student loan, mortgage loans, and etc. Let's move on to the next topic, which is the effective rate on add-on interest. So when we say this, it is the getting the effective rate with an add-on interest. It is the most basic computation in calculating loans and charging interest. So it is simple enough. See problem example in your screen. So example here. So as you can see, I will read it. A loan with an interest amounting to 15,000 per annum on a $150,000 loan for a year will have an effective rate of 10%. So, however, this is only true if the loan is good for a year. Assuming that 15,000 interest carries a 90-day loan, what will be its effective rate? So we will look out for the effective rate. So in the next slide, as you can see, so there is a formula and a solution on how to get the effective rate with add-on interest. So the formula is the interest divided by principal times days in a year divided by days in loan is outstanding. So since our interest here in the problem is 15,000, so and the principal is 150,000, we will times it to 360 divided by 90. So since our days in a year is to be considered as 360 and the days loans in outstanding we have in the problem given is 90. So we will divide the 15,000 divided by 150,000 times 360 divided by 90 and we will get the 40% and that will be the effective rate with add-on interest. So let's discuss the effective rate on discounted interest. So if the discounted loan is to be applied in getting the effective interest rate, the previous slide will be the formula. Still, we use the same formula, except is the interest is deducted immediately from the principal. So using the same example, so let's read it. A loan with an interest amounting to 15,000 per annum on a 150,000 loan for a year will have an effective rate of 10%. However, this is only true if the loan is good for a year. Assuming that 15,000 interest carries a 90-day loan, what will be its effective rate? So let's looking for the effective rate of discounted interest. So as you can see here in the next slide, in this there is a formula. So the difference between the formula before is wala siya ang principal is wa siya gimaynosan og interest, right? And here in the discounted interest, as you can see, there is the principal is being deducted by the interest. So the formula of this is interest divided by principal minus interest times days in a year divided by days loan it's outstanding. So the solution to get the problem is that we know the interest is 15,000 and the principal is 150,000. So let's minus the 15,000, which is the interest. Our 15,000 is the interest, times 360 divided by 90, and we will get the 44.44%, and that is our effective rate with discounted interest. So remember that, or i-note ninyo nga the effective interest rate on a discounted loan is higher than that of the loan using an add-on interest. So, dapat inyo na siya i-remember or i-note ninyo nga ang discounted loan nga mas dako pa na siya o percentage which is higher than the add-on interest. So, nakita ninyo ganina nga ang sa add-on interest, ang iyang effective interest is 40%, while ang sa discounted loan is 44%. So, dapat mas dako ang discounted loan. So, na siya reason. So, the reason is that the principal, which is the base for the computing the rate, has a smaller amount. Ano siya, guys? I-take note yun na ninyo, okay? So, to discuss the next topic, our next topic is the effective rate with compensating balance. So, as previously mentioned, the formula to compute for the loan to be borrowed is the amount needed divided by. So, here is 1 minus C. So, the same concept will be applied in this case, except that the numerator this time is the interest. So, atong numerator karon is the interest rate. So, the loans with the required compensating balance increase the effective rate of the loan. So, let's have an example here in our screen. So let's read it. So, assume that a company is charged 9% on its own loan for 1 year with a compensating balance of 15%. So, note na 15%. So, what is the effective rate with the compensating balance? So, in this next slide, here is the formula and solution on how to get the effective rate with compensating balance. So it is the interest rate minus 1, 8 divided by 1 minus C. So, what is the C? So, when we the C, it is the compensating balance. So, note na dyan na siya nga ang C is the compensating balance. So, what is our interest rate? So, itong interest rate is the 0.09. I-divide na to siya o 1 minus 0.15. Mamaya to ang compensating balance, ang 15%. So, ang 15%, mo na siya decimal, mo siya 0.15. So, to get that is 0.09, imo na siya i-divide ang 1 minus 0.15 and you will get the 10.59%. Mao na siya atong effective rate with compensating balance. So, other than that, we have another way of computing the effective rate with compensating balance. So, here is our example. So, Connelly Corporation is paying 100 interest for 120 days on a 1,000 loan with a compensating balance of 10%. So, required, how much is the effective rate? Second is assuming that the compensating balance earn an interest of 8 per annum. What is the effective rate? So, our formula here is the effective rate with compensating balance is equals to interest divided by principal minus C. So, nadiri na siya, lahi na siya. Instead nga, if wala tong interest rate, kaya mo itong gabiton, interest over principal minus C, yung katong days in a year, divided by days in loan outstanding, where atong C is the compensating balance. So let's look for the how much is the effective rate daw. So, our effective rate is, here is the 33.33%. So, 33.33%. So, how do we get that? So, using the formula is our interest is 100 divided by principal na to nga 1,000 minus minus compensating balance nga 100. Nga times at 360 divided by 120 kaya mo na siya ang nasa problem. So, we will get the 33.33%. Tapos, number 2 is the assuming that the compensating balance earns an interest of 8% per annum, what is the effective rate daw? So, should the compensating balance maintained in the bank earn interest? So, the interest income will be deducted from the interest payment in the numerator. So, let's times either kani I, interest is equals to 1,000. I-times nimo siya sa 120 divided by 360, we will get the 24.44%. Tapos, atong effective rate is 100 minus 26.67 divided by 1,000 minus 100 times 360 divided by 120. We will get the same amount, which is the 24.44%. And that's how you get the effective rate with compensating balance. You will choose either of two formula. Okay, gets? There is another example on this assumption that the interest is an add-on interest. So, in this case, a situation where the loan is a discounted loan. The interest amount should be included in the denominator as at those, applying the effective interest rate on discounted loan with the compensating balance should be 37.50%. So, how do we get that? Is the 100 divided by 1,000 minus 100 minus 100 times 360 divided by 120, we will get the 37.50%. So that is the another example on how to get the compensating balance. So, the next topic is the effective rate on installment loan. So, as mentioned earlier, an installment loan is an obligation where principal payments are made in series. So, financial institution normally charge interest on add-on basis. So, to compute the effective interest rate of this installment loan, so the formula is the effective interest rate on installment loan is equals to 2 times annual number of payments times interest divided by total number of payments plus 1 times principal. So, and the next slide is the problem, which is the on how to determine the effective rate on installment loan. So, let's read it. So, Concon borrowed 15,000 on a 12-month installment basis with a total monthly payments applicable to interest and principal. So, the interest rate charged by the lending institution is 12% per annum daw. So, 12% per annum. Thus, the interest will be 1,800 for 1 year. Since this is an add-on interest, so the total payment will have a face value of 16,800 for 1 year with a monthly payment of 1,400. So how do we get the 1,400? So 16,800 you divide it to 12 since the 1 year is have 12 months, right? So we will get the 1,400. So the interest has been computed in advance and added to the principal in order to arrive at the monthly payment. So the principal amount of the loan could have been used for only a month, but the interest computation is based on the principal amount of a loan and not on a diminishing balance. So a 1,400 payment per month inclusive of interest and principal, and without actually using the 15,000 for 1 year, gives an approximate outstanding loan balance of only 7,400. Thus, the effective interest rate is as follows. So to compute this is here is our solution to get it. So we all know how to get the effective rate on a installment loan, and we know what is the formula. So the formula is right ganitong ganina. So our 2 is given na siya sa formula. What is our 12? The 12 is the annual number of payments, right? So And our 1,800 is the interest. And our divided by 13, which is the problem ganina nga na ay 13, right? Times principal. O ngano na 13 na total number of payments. Since ang 12 months na to, i-add na to 1, so nahimo siyang 13. Nya i-times og 15, which is our principal. So to get that is 2 times 12 times 1,800 divided by 13,000. Ay, divided by 13 times 15,000. My bad. So, is equals to 22.15%, and that is our effective rate on installment loan. So remember that the formula of each effective rate, right? Okay, noted na ninyo. So our next topic is what we call bankers acceptance. So when we say banker acceptance are mainly used for transactions to finance the shipment and handling of merchandise between exporter and importer. Mo na siya according to Melcher and Arthur 2003. So these are considered as type of short-term financing because they mature in less than a year, normally less than 180 days. So this kind of security entails a small amount of risk because of the banking made by the importer's bank. So let's see an example. So a Philippines company that wants to import goods amounting to 100,000 from an American company. So the Philippine company enters to an agreement with the American company for the latter to grant credit for 90 days from the shipment date. So once the credit is granted, in order to be assured that it will be paid, so the American company will ask the Philippine company to apply for a letter of credit authorizing it to draw a 90-day draft from the importer bank. The Philippine company, once it satisfied its own bank, for example, RCBC, regarding its credit standing, must sign a contract promising to pay amount of draft plus any related fees. RCBC then issues the letter of credit addressed to the American company authorizing it to draw a draft payable in 90 days amounting to 100,000. So the letter of credit received by the American company stipulates certain conditions regarding to the exportation of goods. Failure on the part exporter to fulfill the conditions set in the letter of credit will release the bank from its obligation to accept the draft to be drawn. So that's all the about of the banker acceptance. So hopefully you will remember all of this topic I've been discussing, and the next chapter, the next reporter will be discuss the other topic about the short-term financing.